So we just left off with our lecture about the accounting process and the accounting equation here with these accounting principles. So now we're ready to move on to the accounting equation. And what I like to do is have students, before we start, sort of jumping into terminology and things that may be brand new to you, I like to break this down into things that you can apply to your own life, right? So instead of thinking about this in terms of a business or a company, let's just think about it as from a personal perspective, okay? The accounting equation, as you can see, I have 3 boxes here. The accounting equation is going to be broken up into 3 categories. And again, we'll work our way through them and use and learn the more technical terms once we kind of go through this personal example. So in this personal example, what I want students to think about first is on the left-hand side, the furthest box to the left, what types of things can you as an individual or your family own and benefit from having, right? What are things that you own, and because you own them, you benefit from having those things, right? I would say that the first thing that I own and benefit from having is cash, right? I have cash in my bank account. If this thing would let me draw, I have cash in my bank account, and that helps me, right, be able to pay my bills, be able to buy things. All of that I'm able to do because I own cash. I'm able to benefit from having that cash. So what are some other things that I own and benefit from having, or that you own and benefit from having, right? That you have spent your cash on, and now you own these things and you can benefit from having them, right? So I would think of a car, a home, clothes, jewelry. I have furniture in my home. Computers, right? These are all things that I, as an individual, own, and I benefit from having them, right? I benefit from having computers or phones and devices because I'm able to teach my classes, right? I'm able to communicate with students. I'm able to do my job because I have these devices, right? I benefit from having furniture, right? I'm able to be comfortable with my family in my home. I benefit from having a home, right? I have a roof over my head, keeping me warm at night. So things that an individual or family can own and benefit from having. That's the first component of the accounting equation. And again, before we get into the technical terms, I just want us to sort of work through this personal example. So the next box over, right? How would I, as an individual, you as an individual, right, or your family, obtain the money needed to purchase those things, right? So specifically in this box, right, what I want us to think about is, what if I wanted to purchase a home? What if I wanted to purchase a car, right? Those are large purchases. I may not have the cash in my bank account to do that. So what I would be required to do is to go out and get a loan, right? I can go to a bank, I can apply for a loan. They would give me the funds that I need in order to buy my home, in order to buy my car. So that's one way that I, as an individual, you as an individual, would be able to get the money to purchase some of those items. I can get a loan, okay? Now, the final box to the right, how else could an individual or family obtain the money or to purchase those items, or just get those items, right? How else could I do that? Yes, I can take out a loan, right? That's already included in that middle box. But another way that I could obtain those things or get the money to obtain those things is through gifts, right? I may get a device as a gift, or I may get cash as a graduation gift or as a birthday gift. And that gives me the funds that I would be able to use then to purchase any of those things in the first box on the left-hand side. So gifts, right? That's one way that I would be able to obtain those items or obtain the money to get those items. Another way is I have a job, right? And so I can use my own income, and that income that I've generated by doing my job, right? That gives me the money that I can use to purchase those items, right? So this personal example is the same sort of thought process that we want to go through when we're thinking about the accounting equation as it applies to a business. We want to think about these same things, right? So again, I just like to go through this personal example because I think it sort of connects you a little bit closer to the accounting equation and kind of understanding what these different elements of the accounting equation actually are. So let's now think of this in terms of a business, right? So we're going to go through the same exercise, but we're going to think about it in terms of a business, right? What types of things can a business own and benefit from having? And by the way, some of them are going to be the same as what we listed on the personal example, right? A business can own and benefit from having cash, right? A business can own and benefit from having buildings, maybe not a home, but definitely buildings, cars. Maybe they use equipment in, if they're a manufacturer, or maybe they have to use equipment, like think of a store like Target. They have to use forklifts and things to get their goods out of the back room and put them on the shelves, right? They could have different fixtures. If it is a retail store, something like Target, right, that they have different fixtures out in the retail shopping area that they have to use to display all of their goods. How about the goods themselves, right? Those goods that a place like Target is selling to their customers, those goods we actually call in accounting inventory, right? So there's inventory on the shelves that the customers can come in and purchase. What if a company needs computer equipment, right? Just like individuals need computers. Maybe they have supplies, right? Maybe they need office supplies. So these are all examples of things that a business can own and benefit from having. Okay. So again, some similar to the personal example and some a little bit different because we're talking about, a company. So now, how would a business obtain the money to purchase those things, right? They could, again, either take out loans or they could purchase those items and say, I'll pay you later, right? So say we want to buy some supplies for our office building. We could have a supplier, a vendor that we purchase supplies from, and they will give us the supplies even though we haven't paid them yet, right? We will pay them later. Those are all sort of short-term temporary loans that we're getting, the same way that we talked about it with the personal example, right? We don't have to pay right now, but we will have to pay it later. All of those sort of short-term loans that we would get, we're going to call liabilities, right? So we're going to have a lot of different terms that we learn in the next couple of lectures. Liabilities means anytime we owe money to someone. So maybe we do get a big loan, right? And that big loan helps us purchase a building. We would call that in accounting terms a note payable, right? Or maybe we just, like the first example, we have supplies and we're just going to pay for them maybe a month from now, maybe 2 months from now. We don't need a big giant loan, but we just need a little bit of time before we actually pay for those supplies. We would call that accounts payable, right? So what you're going to find is that anything that has a payable on the end of it, right? These are liabilities. This is basically saying that we're obtaining the items that we need, but we're not going to pay for them until later. We owe somebody money, liabilities. So that's the middle box. Now, the next box, and again, remember, those liabilities relate back to the loan from the personal example. So let's think about how else could a company obtain the money to purchase the items from the first box. In our personal example, we said gifts and income. And those same things are going to apply to a business as well, except instead of calling it gifts, right? What a business gets is an investment from the business owners, right? So in the previous lecture, we talked about corporations, and we said corporations are owned by shareholders, right? By stockholders. Individuals or businesses can purchase the stock of a company and then they become part owner. So anytime those owners provide investment funds to the business, right, then the business can use those funds to purchase any of the items that are in the first box. So instead of calling it a gift, like we did with the personal example, we're going to say investment from owners, right? That's a way that that a business can receive funding, receive money that they can then go and buy those items. And then the next example that we said in our personal example was, how else could an individual obtain money? Well, they could use their income. Same thing will happen when it comes to a business, right? They can, oh, what happened there? Let's go back. Here we go. They can use their earnings. So we're going to say earnings. We can also call it retained earnings. That's what you're going to see in the next slide. Retained earnings. But essentially what this is the company's income, right? So what income has the company generated from selling their products or selling their services to customers? They can use that income to purchase any of the items that are over there in that first box, right? So this business example leads us to understanding what the accounting equation is. The accounting equation says that anything that a business owns and can benefit from having is called an asset. And the way that businesses can obtain those assets is either by taking out a loan, having to pay it back later. We call that a liability. Or they can use owner's investment, which in this example, again, is called common stock. This is investment by owners, like we said on the previous slide. Investment by owners in accounting terminology is called common stock. And then they could also use their earnings, right? How much income, how much earnings have they generated over time? Retained earnings. So the accounting equation says that assets equals liabilities plus these two components of what we call equity, right? So assets, you're going to see me use this a lot. Assets equals liabilities plus equity. But then we break that equity, right? That equity consists of two different things. One, the investment by owners that we call common stock, and two, retained earnings. That's the income that the company has generated over time. And they can use that income to help purchase any assets that they want to purchase, right? So our accounting equation, the way that we're going to account for business transactions is by making sure that our assets, the things that we own and can benefit from having, are equal to our liabilities, anything that we owe still, right? Any loans or any sort of short-term items that we're going to just pay off maybe in the next 30 days. And equity, which we can break down into two components. Common stock, that's our investment by owners. Anytime owners give funds to the business, we call that common stock, right? They have common stock in that business. And then retained earnings, earnings that the company has kept over time, that they have earned over time, and they're able to use that to purchase their assets. So this is the breakdown of the accounting equation. In the final video for this particular set of lectures, what I will do is walk through in even more detail this accounting equation by making sure that we understand what are all of the different examples of assets, of liabilities, and then of these two components of equity that we need to understand in order to analyze a business's transactions.